friends, welcome to part 3 of changes in group structure. So in part 2 I have discussed all illustrations. I went through illustrations from your textbook chapter 19 of SBR Kaplan textbook. Now I'm going to finish test your understanding, all the test your understanding. There are 9 test your understanding in chapter 19. So test your understanding 1, Major and Tom. Major is okay. Before that, let me read the requirements. Discuss how to account for the purchase of additional 20% holding in Tom in the consolidated financial statements. You have to discuss. But discuss does not mean that you should not calculate. It's just theory. No, you have to calculate also to support your discussion. Major is a public limited company, has numerous subsidiaries and has prepared consolidated financial statements for many years. Major acquired 40% of Tom, 100,000 on 31st December 2004 for 90,000 in cash. Okay. This holding gave Major significant influence over Tom. That means he's an associate. So if it's an associate, what should you do? You have to use equity accounting. The retained earnings of Tom at this date was 76,000. Okay. Major acquired further for 20% on 31st December 2006. That is after 2 years for 70,000 in cash. On this date, the fair value of the previous 40% in Tom was 105,000. Remember, when you are doing step acquisition, they will give you the fair value of the previous holding. Okay, and Tom's retained earning balance was 100,000. The NCI should be valued using the proportion of net asset method. In the illustration in the previous video, we were doing net assets. Sorry, NCI we were calculating using the fair value. Now we have to use the second method, that is the proportion of net asset. So how do you start this? You start by saying whether purchasing this additional 20% makes you a subsidiary from associate or not, gives you the control or not. Okay, so if you see the answer, so this increase in holding from this to this is achieved control in stages. This will be dealt under IFRS 3. Okay, and the previous investment, because it is revalued to fair value, that gain or loss also has to be presented in the statement of profit and loss. The prior 40% gives a significant influence. Okay, so this means he was previously classified as an associate. That means you have to use equity method. Previously they have used equity method and it was recognized at cost of 90,000. Again we'll see the 90,000 cost. Yes, 90,000. Okay, that's the cost. Now, so you may even though he's an associate, you have to recognize its share of profit, right? So would have recognized a share of Tom's profit and other comprehensive income. Don't forget that. So that you have to add with that cost 90,000. Okay, this is the equity method that they are using, even though they are not showing it in calculation, but in the discussion they are writing it in sentences. That's why it's a little bit confusing. So as such, by 31st December 2006, remember you have to write the dates also. Write the dates at which date you are calculating what. Okay. So at 31st December 2006, the investment in Tom will be carried at 99,600. How? Because associate is 40%. Okay, you have to take the post acquisition profit that you have to add with the 90,000. 100 minus 96. Okay, so 100 was the retained earnings. If you see, the retained earnings was 100 and here the retained earnings is 76. So that difference, post acquisition profit, you have to take 40%. Okay, this will be in the consolidated financial statements. Now when the control is achieved, okay, and write your answers in different paragraphs when control is not achieved versus when the control is achieved. So the previous investment will be revalued to 105,000. Okay, and remember this will be included in the goodwill calculation because now you have to calculate goodwill. Now you became a subsidiary when you purchase that additional shares. That's why you need this fair value of the previous investment. So what is the gain? 5,400. How? Because remember when we calculated the associate, I will highlight it. It was 99,600. So now it is fair value of 105. So that difference is known as the gain. It will be recorded in the profit and loss. Okay. So now because the control has been achieved, the word is control. He must measure and recognize identifiable net assets at fair value. And also he must recognize goodwill arising on accusation. So how this is calculated is shown below. Okay. Even though they didn't ask for this, they asked discussion. But in discussion you have to calculate this. Okay. Because in the revision kit questions you must have seen that they ask you which supporting calculations explain or which supporting calculations discuss. So fair value of previously held, you write the fair value only. Everything is in fair value terms, okay? Even the consideration is at fair value. But for what consideration? When you bought the 40%, initial 40% or for that additional purchase, for that additional 20%, 70,000, okay? Let me show you that 70,000 again. It is this 70,000 when you bought the further 20% because at that time you became this one subsidiary. When you become a subsidiary only you calculate goodwill NCI. So that's why it's 40 plus 20 60, hence NCI is 40% of 200,000. Okay, NCI. Why 200,000? Proportionate of net asset. Okay, NCI, they have not given you the fair value of NCI. You have to take 40% of 200,000 of the net asset. So net asset, if you see here, you see proportionate of net asset method. So when you're taking the net asset, you have to apply 40% there. Okay. So now, less fair value of net assets. So how did they get net asset? 100,000 of the share capital plus 100,000 of the retained earnings. This is how you get that 200,000 and finally the goodwill. Okay, let me show you the net asset part before I go to the understanding 2. So this 100,000 is the share capital and the retained earnings. So this 100,000. Okay, you have to take. At the date of accusation, you have to take. Okay, that's why you are taking 100,000 retained earnings. You are not taking this 76,000. This is at the reporting date. You have to take at the accusation date what is the retained earnings. Okay, at accusation. You see everything is at accusation and everything is at fair value when you're taking goodwill. Now let us go to test understanding 2. So here there are 2 requirements. Requirement 1, calculate the profit or loss arising to the parent entity on the disposal of the shares. So this is just for the parent, that is individual, and this is for the group. The transaction is the same. Pet Stow purchased 80% in State Mine 4 years ago for 100,000. That means that's the cost purchase consideration. On 30th of June, it sold all of its shares for 250,000. That means he lost the control. The net asset was given 69 at the disposal date were 88,000. Okay, net asset. 50% of the goodwill arising on the accusation had been written off in an early year. That means impairment. 50%. Okay. The fair value of the NCI was 15,000 and use full goodwill method. That means fair value of NCI. So now how do you find the profit and loss? Earlier we have discussed this in the illustration in part 2. You must have seen that for individual it's easy. You just take the sale minus the cost. So you sold it for 250 and the cost was 150. Coming to the consolidated accounts, there's a pro forma. You have to learn this pro forma. So you start with the sale proceed. It is the same sale proceed. Net assets at disposal date is given. Okay, but goodwill and NCI at the disposal date you have to calculate. Now everything is at disposal date. And finally you are finding the profit. If you see the profit, these are 2 different. Okay, it will be different. So let us go to the calculation of the goodwill. Because when you're disposing, you will not be having any assets and liabilities. Everything you have to dispose. That's why net asset also you're disposing. You have to deduct from sale proceed. Goodwill also you're disposing. Okay. And there should be two columns like this. Your NCI will come in the inner column, and it has to be deducted from your net assets and goodwill. And finally, this answer will be deducted from your sale proceed to find profit or loss. Coming to the goodwill. So goodwill, you start with the consideration, right? When you first bought it, 100. Plus NCI is given, the fair value is given, and net asset is also given, the fair value. You deduct, and goodwill. So they told 50% is impaired. So it's easy to find. This 23. And coming to the NCI. NCI at acquisition is 15, okay? It's given. Next, what do you have to do? Two things you have to take care of: net asset and impairment. Okay, and NCA is 20%. Because first you have bought 80%. So that time it is NCA is 20%. Not most of the people get confused that how NCA is 20% because we are disposing entirely, so NCA should be 0%. No, NCI we take when we first bought, when he's a subsidiary at 80%, so NCA is 20%. That we are disposing now. Okay, that 20% NCA. So NCA post acquisition, that means net assets at the date of acquisition minus the net assets at the date of the disposal. The difference. Okay, at that difference you have to take 20%. And the impairment, this impairment, 23. It's an expense. So that expense also you have to deduct from the profit of the NCA. This is like the post acquisition profit only, and this is the expense, this impairment. So you have to deduct the NCA as percentage, 20% of 23. Hence 14.2. Now let us go to test understanding number 3. Here also part A is the same thing. In the individual financial statements, in the consolidated financial statements, the profit or loss arising from the full, assuming that this is a full disposal, okay, of 10 million, that means entirely you are disposing of. Coming to B, you are only disposing 35% for 5 million. Here also calculate profit and loss in the consolidated financial statements, and the second one is you have to explain how the residual shareholding, that means the remaining shareholding, will be accounted for. You have to know both, okay, the amount that you are selling also, the amount that you are not selling also, how to account for both. So now there's a 60% investment, and you have to use full goodwill method. That means fair value of NCI will be given. 60% means he was a subsidiary. Okay, half of the goodwill has been impaired. That means 50% before the disposal. Now you have been given all those things: cost of investment. Okay, fair value of net assets at acquisition, net assets at disposal, fair value of 40% investment at acquisition date, and fair value of 25% investment at disposal date. Okay. Now, in the individual financial statements, it's easy. Sales minus this one. So you have selling it for 10. So 10 million minus the cost of investment. 10 minus 6 million. Right? 4 million is the profit. This is easy. Coming to the consolidated financial statements. Whatever we did in the illustration, test understanding to the pro forma. You're selling it for 10 million. Okay, there is no retained interest, it's nil. Because you are selling it entirely. So when you are selling it entirely, there will be no fair value of retained interest. Net assets at disposal is 3 million. Okay, just 3 million. And this 3 million. Okay, then goodwill, we have to calculate that. And NCI also we have to calculate at the disposal date. Everything has to be at the date of disposal only, by the way. And finally you're finding the profit. So let us go to the goodwill. Goodwill is consideration, that is 6 million, plus NCI at acquisition, that is 1 million, and fair value of net assets at acquisition 2 million. Okay, just give me a 1 and 2 million. So fair value of 40% investment means this is NCI only. Okay, This is NCI. And this 25% means this is also NCI. This is at the date of disposal. So from that table, you deduct, and goodwill is impaired 50%, hence this is the goodwill at disposal. Okay, and working number 2, NCI. So NCI accusation is this one. Okay, and post accusation net asset, that means net asset as at accusation date minus at date of disposal, and you have to take 40% because 60% you have bought. Now you have to deduct the goodwill impairment also because you have used fair value of NCI. So 40% of this one impairment. Remember that you first have to calculate impairment to find the 40% of that. Okay, otherwise you cannot use the 40% of goodwill impairment. And then this is the NCI. So now you put that in the table here and find the profit. Now let us go to the part B where you are disposing 35%. That means you are not selling entirely. That means from 60 you are disposing 35, you are becoming 25%. That means you are becoming an associate. You have to use equity method now. Okay, in the consolidated, here they didn't ask you the individual, here they just asked you the consolidated financial statements. So for consolidated financial statements, pro forma is same. The only thing added is we have a fair value of retained interest. The rest all remains the same. So disposal procedure, disposing it for 5 million, fair value of retained interest is 3.5. Net asset at disposal, it remains the same. Goodwill at disposal. So if you see goodwill at disposal here, this remains the same. This also remains the same. 3 and 2.5. 3 million and 2 million. Only this changes. No, this also remains the same. NCI. Because you're losing control. That's why. So everything remains the same, only this is added here. And hence now this is the profit. Now you have to explain how to account for that remaining. That means how to account for that associate. So the residual holding will be, you have to use equity method. Okay. So you have to talk about the statement of profit and loss as well as the statement of financial position. In the statement of profit and loss, you will be showing the group's share of the profit earned by the associate from the date the significant influence was obtained. And for the statement of financial position, you have to show the carrying amount or the carrying value of the investment in the associate. What is that carrying value? This will be the fair value of the retained shareholding in the disposal date plus the group share of the increase in reserves from this date. That means the group share of the associate's profit plus the fair value of the retained shareholding at the date of the disposal. You add this and that amount will go in the statement of financial position. And it will be named as investment in associate. Now let us go to test understanding 4. Kathmandu. Nice. So you have been given the profit and loss account. And here we have the statement of changes in equity as well. No other items of comprehensive income during the year. Okay. We have some additional information and we have multiple of requirements to prepare. Let's see. Prepare the group statement of profit and loss for the year ended of Kathmandu Group on the basis that Kathmandu PSC sold its holding in Nepal on 1st of July 2009 for 200,000. This disposal is not yet recognized in any way in Kathmandu's group statement of profit and loss. It is not yet recognized. Okay. Assume that Nepal does not represent a discontinued operation per IFRS 5. Now B. Explain. You have to explain as well as illustrate. Illustrate means you have to show through calculations and all. Or maybe you have to show the presentation. How the presentation of the group statement of profit and loss would differ from Part A if Nepal represented a discontinued activity per IFRS 5. Part C. Prepare the group statement of profit and loss for the year ended 31st December 2009. For Kathmandu Group on the basis that Kathmandu sold half of its holding in Nepal on 1st July for 100,000. Okay, and the residual holding of 35% had a fair value of 100,000. Remember, when you're not selling entirely, whatever is remaining, they will be giving you the fair value of that remaining holding. Okay, so the residue holding of 35%, that means the associate's fair value was 100,000. Significant influence or not, that means it's an associate. Now let us read the additional information. So the accounts of the Kathmandu group do not include the results of Nepal. Number 2, on 1st of January 2005, he acquired 70% for 100,000 and fair value of net asset was 110, equity capital 50,000, fair value of NCI was 40,000, measure NCI at fair value. Nepal paid his dividend in cash. Okay, paid its 2009 dividend in cash on 31st March 2009, and goodwill has not been impaired. So how do you start this? If you see, before that we have to find out we have to start with the workings. Okay, let us directly go to the working. So working number 1, this is for party. Profit on full disposal, you are entirely disposing it. So you're disposing it for 200,000. Okay, net assets at disposal, there's a working. Net goodwill at disposal is working 3, NCI is working 4. So separate working for each. Okay, remember, you don't have to calculate for each part A, B, and C different. You only have to calculate once only. But that calculation, that workings, you have to do only once. But the way you present will be different if the situation changes. That's it. Okay. So net assets at disposal. Okay, the Nepal share capital is given, the retained earnings brought forward. This is the reporting dates retained earnings, not the acquisition dates retained earning. Okay, and profit up to the disposal date. Only for 6 months you have to take. Because for 6 months only he was a subsidiary. 36,000. Okay, remember when you are taking this 36,000, it is a profit. Just. It is this 36,000 you are taking 6 months profit for the year. Okay. And here they have given you the shares already. Okay. The value of shares 100,000. Nepal had an equity capital of 50,000. Okay. And if you see the retained earnings is 80,000. $106. So if you take the retained earnings, the brought forward retained earnings, you have to take 80,000 and dividend 10,000 paid before the disposal, you have to deduct that. So finally, you are getting the net asset. So once you get the net asset, go to the goodwill. Goodwill, the consideration when you bought it. And then NCI date of acquisition this time. And net asset also at the date of acquisition, everything is given. So goodwill also you can calculate. It is not impaired. Let us go to the NCI working number 4. So NCI, you start with the fair value of NCI at the date of acquisition is given. Okay, you can take this only. And 30%, because at first you have bought it for 70%, at that time NCI is 30%. Okay, so net assets at acquisition was 138 minus 110 at the date of acquisition. So you deduct at the date of disposal minus at the date of acquisition. That change in net asset only, you have to take 30% of it. Okay, net asset at acquisition 110 is given and 130 is given here at the date of disposal. Hence this is the net assets. Now profit that is attributable to the NCI. Oldest 6 months of 36,000 you have to take. Okay, and on that you have to take 30%. Only this There is no impairment, no depreciation, no changes, so only the profit. That's it. Coming to part C. If there's a part C, you have to find the profit because there's a part disposal. And this is the pro forma that you have to learn for part disposal. Okay. So you're selling it for 100,000. Fair value of retained interest is also 100,000. NCI at disposal already is calculated. These things are calculated as it is. You can take net assets, goodwill, and NCI, but at the date of disposal. The only thing that is changed is only this thing and this amount, maybe, for part disposal. And you are finding the profit on disposal 80,400. Okay. Now let us go to the main table. So for part A, this is a full disposal, how you are going to disclose it. So when you're taking the parents, you can take entirely and 6 months only for the subsidiary. For all the things is like that, all the revenue and expenses. Except for investment income, when you come, you have to take 10,000 into 70%. What is just 10,000 into 70% that you're taking for investment income? Just let us go to the investment income. Okay. So when you're going to the investment income here, you have bought for 70,000, right? 70%. So at that time, you have to take the 70% of 10,000 and deduct it from this investment income. What is that 10,000 that you are deducting? What is the 10,000 you're deducting? When you're finding the fair value of the, it is this 10,000 that you are taking the dividend. You have to deduct it from the investment income. Okay. So that's 70%. You are deducting that dividend. And then you're finding the profit on disposal. This is for part A, full disposal. Okay. And you are taking the consolidated disposal, not the individual disposal. And tax you deduct and then profit. Once you come to this profit, NCA we have already got, and the remaining is for the equity holders of Kathmandu. Coming to part B, you are showing it as a discontinued operation. Okay, just so when you are showing it as a discontinued operation, how are you going to write it? If you show here, you are just writing this. You are not taking the Nepal. You are not consolidating Nepal. You are just writing it as it is, and you are reaching here 71,000 from the Kathmandu's group. Okay. But we have one more investment income. This you have to deduct that 70% of dividend 10,000 you have to deduct from this 8,000. Okay. And then profit before tax and tax, because that's a dividend from associate. So you have to minus it from the investment income. I'm sorry, it's a subsidiary's dividend that you have to deduct it because it's you cannot take it. Dividend and all is eliminated. And then finally you're finding the tax. Once you come here, profit for the period from continuing operations, you have to write like this. Then you are moving towards profit from discontinued operation. This is the line that you are writing. And how are you going to find out? This 36,000, the profit from the subsidiary, You are taking older 6 months. You are adding 80,400 with it. What is this 80,400? It is then working number 1. It is this profit on disposal. Okay, profit on full disposal. Because that only we have to show. That you have to add with this discontinued operation. Hence this. And finally, you have to attribute this also like this among the NCI as well as the equity holders. Now, notice that the post-tax results of the subsidiary up to date of the disposal are presented as a one-line entry. Okay, there is no line-by-line consolidation when you have adopted this method of presentation. That means when IFRS 5 is there, you cannot adopt line-by-line consolidation. You cannot do. And coming to part C, partial disposal. So you only have to take for 6 months everything, right? This we have done. So that's it for test understanding 4. Let us go to test understanding 5. Gordon has owned 80%. Gordon is acquiring more shares in Monday. The NCI has 20,000. Net asset is 125 and goodwill is 25. Two scenarios, okay? You have to calculate the adjustments that are required to NCI and other components of equity. That means control is not lost when you are disposing or you are acquiring. So he could buy 20%, leaving no NCI for 25,000, or he could buy 5% for 4,000, leaving a 15% NCI. Because from 80 to 85 it becomes 85 and then NCI is 15%. But if he buys 20%, 80 plus 20, 100, no NCI. So now you have to calculate what is the adjustment. Let us go to the calculation for the first. And this is the pro forma again. Okay, you have to memorize it. When there is a change in NCI, when there is no control, that is lost. So you have paid cash, that will be credited 25,000. And there's a decrease in NCI. Why? Because earlier NCI was 20%. When you have 80%, now you bought another 20%, NCI reduced. So it will be 20 divided by 20. Decrease in NCI. The difference, first of all, the difference 20 minus 0 over 20, because 20% is your initial NCI. That's why it's 20% over 20% into 20,000. It is the 20,000 is what? The carrying amount of NCI that you have to take. Hence 20,000. It's a debit. So 25 minus 20 is a 5,000 and this is debited. Okay, decrease in other components of equity. Whenever your NCI is decreased, other components of equity also will decrease and it's debited. Come into this one. You have bought it for 4,000 is credit, and here the change is 5% only over 20, because initial NCI is 20%, old NCI into 20,000. So 5,000. Here it's an increase in other components of equity because it's 1,000. It is, even though it's in bracket, don't go by the bracket sign, okay? Because the cash paid is less than that decrease in NCI. So it's 1,000 credit and it's an increase in other components of equity. You have to check like that, okay? So earlier I told that when there's a decrease in NCI, other components of equity also will decrease. That's not correct. The reason is because here cash paid is more than your decrease in NCI. That's why it's a debit. Equity reduced. But in this case, cash paid is less than your NCI decrease. Therefore, there's an increase in equity. So don't see this bracket sign that it's a bracket, why it's an increase. That's a bracket is there because 4,000 minus 5,000 is minus 1,100. That does not mean equity is decreasing. Okay. So it's a credit. Coming to test understanding 6. Debit. Discuss how the share sale should be accounted for in the consolidated financial statements of the David Group. David is owned 90%. and he sold 5% for 5,000. From 90 minus 5 is 85% holding now. It's still a subsidiary. So net asset and goodwill was 70,000 and 20,000 at the date of disposal. And NCI was valued at fair value. Okay, so now let's see. Even though this reduced, okay, still there is no gain or loss. And goodwill is also not remeasured because he is still a subsidiary. No change of control, no loss of control. So this transaction is accounted for in equity, and there is an increase in NCI. Whenever you are disposing, NCI will increase. Okay. So let's see, according to working 1, you are selling it for 5,000. Here you are debiting because you are receiving that 5,000, and here it will be an increase in NCI when you are disposing. Whenever you are purchasing, decrease in NCI. When you are selling, increase in NCI, and the change is 5%. 70 plus 20. Whenever NCI is not given, it is goodwill plus your net asset that you have to take. 4,500. Here it is an increase because cash receive is more than your increase in NCI. Therefore, it's an increase. Okay. So you have to explain here. The difference between this and the increase in NCI is recognized as an increase in 500 to group equity. Test your understanding. 7. Statement of financial position for 3 entities are given. Pepsi, Sprite and Tango. Investment in Sprite, investment in Tango. What are you required to do? Discuss how to account for the purchase of additional 8% in Sprite and sale of 10% in Tango. Remember, in your main exam, right, in your SBR exam, they will not give you such complex issues. Purchase of one, sale of one, so much of calculations they will not give you for 30 marks. It is discussions also and calculations also. Okay, usually they will give you extracts and all. But it's better to know while you're preparing, it's better to do full thing so that you know. So let us go through the investment in Sprite. Pepsi acquired 80% and retained earnings was 25,000 of Sprite. This is the purchase consideration. NCI at fair value, and this is the fair value of NCI, 65,000. They purchased additional 8%, that means from 80 to 80% for 26,000. This amount has been debited to Pepsi's investment in Sprite. Okay. So before we go to Tango, we can account for Sprite. Okay, we can come to Tango later. Just okay. So if you see the answer, so all these workings are required for Tango. First, it is the purchase of additional 8%. So when you're purchasing additional 8%, it became from 80 to 88. Still, it's a subsidiary. There is no change in control status. That means no gain or loss. And goodwill is also not remeasured. These are some keywords that has to be there. Immediately, it has to be written in your answer the moment they tell you to discuss. So this transaction is accounted for in equity, and there's a decrease in NCI. Remember, when you're purchasing additional shares, there's a decrease in NCI because you're buying that from your NCI only. So this decrease in NCI, how will you write it? In calculation, okay, you can calculate, but how do you write it? You write it like this only. You can copy paste this answer. Decrease in NCI will represent the proportionate reduction in the carrying amount of the NCI at the date of additional purchase of shares. Okay. So the difference between this was the consideration that is paid, and this is the decrease in NCI. So this amounts to 6,000. Okay, this is increase in equity. Why? Because your cash paid is less than your decrease in NCI. So because it's a subsidiary, so control. Okay, you have to find out this. It's a control to control adjustment. Cash paid minus NCI. So first you have to find this 8%, the change. Okay, 88 minus 8. The change. He bought 8%. That means earlier he was when it was 80%, he was an NCI at 20%. That 20% only you have to write. The initial, not after he became 88, what is the NCI? No, into 80. Okay. How 80? You have to calculate it in working too. NCI at acquisition is given 65. You have to add the post-acquisition reserve. So 20% of 100 minus 25. Post-acquisition reserve means the retained earnings and all. How much it increased, which is 80. So on this 80 only you have to take this proportion. Okay. So that's it for the Sprite. Now let us go to the Tango. Before going to the Tango, we have to read his scenario. He acquired 75%. Retained earnings was 60,000. Cash consideration was 200. Fair value was 50,000 of NCI. He sold 10. That means from 75 to 10. Okay. For 35,000. Now let us read. So this is also control to control. Same. No control is lost. No gain or loss. Goodwill is not remeasured. Here also there's an increase in NCI. Okay. So you have to calculate it. But this is a sale. So because it's a sale, you are receiving the cash. And increase, there will be an increase in NCI because it's a cash disposal. Okay. So 10%. Because from 75 to 65, right? Is it, or is it 70 to 60? I forgot. It is 75 to 65. They are sold in 10%. So that means NCI will increase by 10% into 300 plus 90. That means this is the net asset. This is the goodwill that you have to calculate. If they don't give you the NCI. Did they give you the NCI here? No. They give you the NCI at the date of acquisition as 50,000. You need at the date of disposal. It's not given. This is a decrease if you see because cash received is less than your increase in NCI. So if you see the net asset, you have to find out and goodwill. So net asset, how do you find out like this? Share capital will remain the same as the reporting date. Retained earnings will change at the acquisition date versus the reporting date. Okay. At the reporting date, it will be given in your statement of financial position. Okay, let me take you to the statement of financial position. This is the retained earnings in the statement of financial position. That means this is your reporting dates retained earnings. Whatever is given in the paragraph below is for acquisition. Okay, that's how you understand. So net asset, if you see 160 and 300. So you have to take the reporting days, the 300. This one, not 160. Coming to goodwill, consideration, net NCI. Remember, when you have first bought the 75%, that time you have to calculate this goodwill. You don't have to calculate goodwill again at 65% when you're disposing 10%. Okay. NCI at acquisition 50. And fair value of net assets at acquisition already calculated. This only. At acquisition date, you have to take the net asset at 90. So you add that 390, take 10% and all. Okay. So it's simple, guys. It's not easy. Isn't hard. It's just that you have to practice this area more enough because this area is something new in SBR. Coming to test understanding 8. So we are just left with the last two test understanding 8 and 9. Before we go for overseas subsidiaries and all and how to deal with foreign currency. Raven. Discuss the accounting treatment of the above in the year ended 31st December 2002. He purchased 25% shares for 1 million, giving significant influence. That means associate. Retained earnings was 3 million. On 30th June 2002, he sold 20%. From 20 to 20%, that means 5% is remaining now. So 5% holding was, and this was sold for 2 million. The balance on the retained earnings was 3.8. Has never had any other components of equity. The 5% holding was worth 0.5 billion and 0.6 on 31st December 2002. Remember, this is a financial asset now. You have to deal under IFRS 9. Okay, because 5% holding. That means you have to be good in your IFRS 9 as well. So group accounting tests many areas of your standards. It's not just group accounting, so you just know how to consolidate. That's it. No, you have to know many other small standards in group accounting. For example, IFRS 9 you have to know relating to financial instruments. You have to know IS 7 for your cash flows and all. Then you have to know your IFRS 5 for non-current assets held for sale. IS 16. There are so many other areas that you have to know for group accounting. Okay. So this means there's a loss of significant influence. You cannot say loss of control because he didn't have control initially also. At 25% also there was no control. This is loss of significant influence. So he's no longer an associate. That's why you have to de-recognize this associate. Okay. Associate is initially recognized at 1 million. Now you have to de-recognize it. And also associate's profit. Okay. At that date he must have accounted for its share of profit. But at the date of the disposal, you have to find out the carrying amount of the associate that you have to de-recognize. What is it? That 1 million that you have initially recognized, and what is the associate's percentage? 25% into 3.8 minus 3. Okay, the change in the retained earnings is 3.8. If you see the retained earnings 3.3 and this was 3 million, so that change in retained earnings, that you have to take the associate's percentage 25% and add with 1 million, hence 1.2 million. This you have to de-recognize. Okay, and now you have to find the profit on disposal also, that you have to recognize in the statement of profit and loss. There are so many areas that you have to discuss. It's not just IFRS 9. Okay, IFRS 9 also we have to talk about, but let us first finish this. First de-recognize and then recognize IFRS 9. So when you're disposing it for 2 million. What about the fair value of the share that is retained 0.5? Remember, when you're taking the fair value of the shares retained, not you have to take this 0.5 at this date when you're disposing, okay, not that 0.6. And then carrying amount of associate, we have just calculated this 1.2. And hence this is the profit on disposal. Now coming to the 5% remaining shareholding. This will be recognized as under IFRS 9 as a financial asset at 0.5 million. Remember the value changed. It went up to 0.6. So that's a gain in 0.1. There's a gain of 0.1 million. And where will it be recorded? In profit and loss. But it could be recognized in other comprehensive income also. Okay, if the shares are not held for trading and there's an election that has been made, that it will be recognized in OCI. But in this case, there is no election and there are no information given regarding it. Okay, but still, even if it's not given, you have to write this statement that it could be recognized under this also if shares are not held for trading. Number one reason, because this is shares, no? And also if there's an irrevocable designation, that means, or irrevocable election, that means you cannot change, you cannot reverse it back. Once you made that election to recognize gain or loss in the other comprehensive income, you always have to recognize it there only. You cannot reclassify to profit and loss. Okay, so that's it for test understanding. And now let us go to the last test understanding, that is 9. Okay, explain with calculations how the above transactions should be dealt with in the consolidated financial statements. So now let us go to Rosa. Okay, Liesel purchased 85% in Rosa. The NCI is at fair value. Liesel sold 5% for 9 million. Therefore, stake at 80% because 85 minus 5. Okay, goodwill is 8 and net asset is 120. So this is the information that they have given, the accounting entry that they have done. Debit cash 9 million because they are selling it for 9 million, and credit profit and loss because they are assuming that the profit that they are gaining is profit and loss. is 9 million because they are selling it for 9 million. So now let us go to Rosa and Hans. First, let us deal with Rosa and then we'll go to Hans, okay? So if you see, there is no loss of control, okay? He controlled both before as well as after the sale of shares. That's why, because he's having the control, that means there's no profit and loss. So it's incorrect to recognize a profit or loss. You cannot recognize a profit or loss when there is no loss of control. That's why this transaction will be accounted for in equity and there will be an increase in NCI because you're disposing. How much will be that increase? Goodwill plus the net assets. Because NCI is not given. Remember when I told NCI is not given? Add the goodwill plus the net assets and take 5% because it increased by 5%. You are disposing by 5% means net assets, sorry, NCI is increasing by 5%. So 6.4 million. Now you have to correct the accounting treatment. This type of question is very, very common in your exam. You have to be prepared 100%. You'll be getting some questions regarding correct, where you have to correct the entry. Okay. So the difference between the cash proceed and the increase in NCI. This has to be recognized as an increase in shareholders' earning. What is it? 9 minus 6.4 because now it is 6.4. But earlier you have recognized 9. You have recorded in excess. So you have to deduct it now. 9 minus 6.4. So this means you will be increasing it by 2.6. Okay. So when you are recognizing, remember earlier you have recognized profit. You have credited. Now you have to debit that. You have to remove that 9 million. And NCI you have to increase it by 6.4. You have calculated this increase in NCI. And other components of equity, 9 minus 6.4 because cash you are receiving is 9. The cash and minus the profit NCI. So this is an increase in other components of equity because cash that you are receiving is more than your increase in NCI. Now we are coming to Hans. Several years ago, Liesel purchased 70% for 105. Net asset was 100 at the date of acquisition, okay? And net asset had a fair value with the exception of freehold non-depreciable land, which had a carrying amount of 5 million and fair value of 15 million, and NCI was 36 million fair value. This is the exam type question, okay? Exactly the exam type question, only the second one especially. But you will be having the net asset also, one asset out of it where the fair value and the carrying amount will be different, okay? On 1st of October 2001, he sold 40%. That means from 70, 40% he has sold for 72. Cash receipt has been recognized, but on the other side, it has been posted to the suspense account. And what about the remaining 30%? They believe this gives a significant influence. That's mean it's a associate. Even if they don't write significant influence, default position is you have to assume it's a associate. Okay. So the fair value of 30% holding is 51 million. This is the extracts from the individual financial statements. Share capital, retained earnings, and profit for the year. The Hans individual statements, okay? They are unsure about how they should treat the investment in Hans in the consolidated statement of financial position. You have to explain with calculations. Don't forget this. Not just calculations, explain also. So let us go to Hans. You have to, whenever you are writing, don't immediately start calculating something. For example, goodwill or net asset. No. You first have to describe the scenario, what's happening. For example, it's a sale. If it's a sale, what's happening? Is there a loss of control or not? If there's a loss of control, then you recognize what. If there's not a loss of control, then you recognize what. For how many months they have been subsidiary or associated, whatever it is. What is the position? You have to explain these things in your first opening paragraph. Okay. So here, he controlled for 9 months of the year. Let us calculate the months. We didn't calculate it. Here on 1st of October. So on 1st of October, they have sold. So from Jan to October, okay, 9 months. Jan to September only because it's 1st of October. So October month, October, November, December, he's a associate. Months is very important. The date is very important. So he controlled only for the first 9 months. That means you can only consolidate for the first 9 months, both the income and the expenses. Okay. So this will have a total impact on what? On the consolidated profit. Write it. What is the impact on the consolidated profit? You have to take 9 months of 20 million. Hence it will be 15 million. Just let us go to the income and not give away just. So profit for the year is given 20. Okay. Out of this only 9 months we are taking, which is 15. And of this 15 million also you have to take 70% only, which will go to the parent, which will be attributable to the equity holders, which is 10.5. And the remaining 4.5. Because 15 minus 10.5 now, so the remaining 4.5 will be attributable to the NCI. Now, the sale of shares. Now, this is the situation before you are selling for the first 9 months. Second, this is the first paragraph, okay? This you can use as a guideline also in your exam also, how to answer. Because you definitely will get a question like this. There's no doubt about it. Explain with calculation. Number 2. Second paragraph, you are telling the impact when you are selling. So this sale of share is a loss of control. At this point, they ceases to be a subsidiary. They are no more a subsidiary. Therefore, they should de-recognize the goodwill, the net asset, the NCI of hence, and recognize a loss on disposal instead. De-recognize and recognize a loss. It could be a loss or a profit, but in this case, it's a loss because you have calculated it of 19.1 million. This is calculated as follows. Because it's a loss of control, so there'll be a profit or loss. Okay, and this is a pro forma. I've told you to remember it. When there's a loss of control. So sale proceed is 72. We are selling it for 72. Fair value of shares written is given 51. Okay. For goodwill and net assets NCI, there are workings. Okay. And all these three are at the date of disposal. The goodwill, net assets and NCI. Okay. And finally, it's a loss on disposal. So let us go. Before we explain this thing, okay, we can explain these things also before we go to the workings also. So after the sale, they retain a significant influence. Okay, that means they have to recognize it using equity method because it's an associate now with the initial carrying amount of this one using equity method. Okay, in the consolidated profit or loss, what should they do? They should report a share of profit from the associate entities of 1.5 billion. How 1.5 million? What is the associate's profit? It was 20 million. And he was an associate only for 3 months, and the percentage is 30% because from 70 he is disposing 40, so 30%. Okay, so this profit, remember the share of the associate's profit, this will increase the carrying amount of the investment in the associate. In the consolidated statement of financial position, you have to refer the place also where it will go, whether it is in the consolidated statement of financial position or consolidated statement of profit or loss and other comprehensive income. You have to write it where it will go and what is the impact. So the initial cost was 51. With that, you add the profit also 52.5 million. You have to write the amount like this and you have to explain. And then you will be giving the workings. Working 1 is goodwill, working 2 is net asset. See, goodwill, you calculate at the date of acquisition, that only you will dispose it. Sorry, that only you will de-recognize it at the date of disposal. You don't write goodwill at the disposal date. But net assets and NCI, we write. Okay. So goodwill consideration when we have first purchased it at 70%, what is the consideration, and NCI at fair value, okay, is given, and net asset. So you take fair value of net asset. Remember it was 100, but there was a change in non-depreciable land, that the cost was 5, carrying amount was 5, fair value was 15. So that's why that increase 15 minus 5 you have to take. Okay, finally the goodwill. Now we are coming to the net asset. You take the share capital, return earnings brought forward at the disposal date. Okay, that means at the reporting date you have to take the disposal. So the retaining earnings at the date of disposal. Fair value adjustment also don't forget at the date of for the net asset you have to take it. And the profit to disposal only for the 9 months. You have to take it because other 3 months is an associate. You are de-recognizing net asset when he was a subsidiary. So only out of the profit you are already taking for the 9 months. That also you have to add. Okay. Hence it is 163. This retained earnings you are taking at the reporting date, not at the date of the acquisition. Net asset. The retained earnings 130. Let me show you. This retained earnings. Reporting date 130. Okay. Now we are coming to the NCI. NCI at acquisition is already given, but post acquisition you take the reporting date 163. Just now we have calculated that net asset minus the net assets at the date of acquisition and you take 30%. Because when you were 70%, NCI was 30%. Not after you are disposing, okay? Let's say you have disposed 30%, right? And you became 40%. So at 40%, you cannot have NCI more than this. You cannot have an NCI when you are not a subsidiary anymore. Okay, so when you are at 70%, what is the NCI at that NCI you have to take percentage, and hence it is 51.9. So that's it. I have finished all your test your understanding relating to changes in the group structure. That means when you're disposing, when you're selling, when you're losing control while selling or disposing, when you're not losing control while selling or disposing, when non-current assets, sorry, when subsidiaries are held for non-current assets, held for sale. So all these things, all these scenarios have been taken into considerations, and all we have attempted all types of questions relating to this. Part 4 will be discussing relating to international subsidiaries and all, related to foreign currency and how to deal with the foreign currency gain or loss when you are translating the subsidiaries statement of profit and loss and other comprehensive income, and also the subsidiary statement of financial position, which rate to take, which rate to choose. All those things will be covered in part 4. So see you in part 4, and don't forget to subscribe to my channel to get the notifications of my latest videos.